Fringe benefits are an important component of an employee's compensation. In this video, we'll introduce the concept of fringe benefits. I'll start with a brief history of fringe benefits and then discuss the importance of fringe benefits today and their taxation. During World War II, the US government faced a major problem: inflation. With factories producing equipment for the battlefield, goods were harder to come by for everyday Americans. That meant that costs increased significantly, and lawmakers tried to help tackle inflation by limiting the maximum hourly wages a worker could receive through the Stabilization Act of 1942. The idea was that by putting a ceiling on what workers could earn, it could impact other areas of the economy and reduce inflation. Employees weren't happy about that move, and neither were business owners. Companies struggled to hire and keep talented workers without the appeal of a higher paycheck or raises. So they began offering extra incentives that were on the fringe of cash wages, like paid vacations and pensions. Acting as a kind of creative loophole, these benefits complied with the law, provided employees something valuable, and also gave employers the workers they needed. It was a win-win-win, and the idea took off from there. By the late 1940s, fringe benefits became a mainstay of labor negotiations as they became popular everywhere. Today, fringe benefits are an integral part of employee compensation and often have a significant influence on the cost of the employee, but also on employee satisfaction. Fringe benefits can be fully or partially paid by the employer and be taxable, partially taxable, or non-taxable to the employee. Some of the most common fringe benefits are health insurance, where the cost is often shared by employer and employee, and retirement benefits, but can include many other perks. Google, for instance, offers free food, cooking classes, on-site gyms, massage therapists, decompression capsules, and on-site medical staff. Cash fringe benefits are always taxable, and certain non-cash fringe benefits are also subject to employment taxes, which means it can be quite complicated, and an employer must be aware of the taxes associated with offering certain types of fringe benefits. For some of these fringe benefits, the employee contributes a portion of the cost, and the payroll deduction can, in some cases, be pre-tax, whereas others are post-tax. Fringe benefits benefit the employer and the employee, even when the employee pays part or all of the cost. Let's look at the graphic. There are fringe benefits that are either entirely paid or in part by the employer. Some of these fringe benefits, such as 401k or tuition reimbursement or health insurance premiums paid by the employer, are not taxable. Other fringe benefits, such as food, off-site gym, or tuition reimbursement above the maximum allowed, on the other hand, are taxable. Let's move on to the second portion of the picture. If the employee contributes any part of the fringe benefit costs, they can claim a pre-tax deductions for some fringe benefits. This means that taxes such as federal taxes are calculated on the gross wages after deducting the employee contributions first. Health insurance, 401k, and FSA contributions fall into this category. Other fringe benefits that the employee contributes to do not receive this favorable tax treatment, like, for instance, optional insurance and union dues. When non-cash benefits were first introduced, they were viewed as an insignificant part of an employee's compensation. Over time, though, fringe benefits have become more important. The company can differentiate itself from other hiring employers, and it can increase the employee's satisfaction, resulting in the employee staying with the employer for a longer period of time. Over time, the Bureau of Labor Statistics has proven that fringe benefits constitute an additional 25 to 33% of an employee's annual compensation. Fringe benefits have certain distinguishing hallmarks. The defining piece of all these benefits is that they're accessible to all employees, improve employees' living conditions, are not related to employee performance, supplement cash compensation, promote the welfare of all employees, may be deducted from pay on a pre-tax or post-tax basis, and may also involve certain legislated tax treatments. De minimis benefits are fringe benefits with a very small monetary value. The term is defined as too trivial or minor to merit consideration, especially in law. In accounting terms, these benefits are employer-paid benefits that are not taxed because of the small monetary value. Examples of the de minimis benefit are occasional postage stamps, coffee, and a designated parking spot. However, if the de minimis benefit becomes a regular enough occurrence to constitute a material value, then the value of the benefit must be considered taxable income. So, for instance, if your employer provides food to employees every Friday, then it is a regular benefit and taxable. Voluntary fringe benefits have two types of treatments regarding payroll taxes: pre-tax deduction or post-tax deduction. Please see the IRS Publication 15B or your payroll accounting textbook for more information on the types of fringe benefits and the related tax treatment. Let's look at an example. Rylan is an employee of Cohen Corporation, a company that offers undergraduate educational assistance as a fringe benefit. According to the IRS, the first $5,250 of Phil's tuition is not subject to payroll taxes. In 2023, Rylan received reimbursement from his employer of $7,250 in education assistance. Since the employer's reimbursement exceeded the tax-free portion of this benefit, the additional $2,000 reimbursement is taxable income for Rylan. In case you're wondering, the maximum tuition reimbursement is unchanged in 2024 and remains at $5,250. Some fringe benefits may increase employee pay and are taxable, such as employer-provided vehicles. Certain fringe benefits change the basis for tax calculations, such as for federal withholdings, Medicare, or Social Security, meaning pre-tax deductions. Fringe benefits that do not affect the calculation for taxes are considered post-tax benefits. Regardless of the tax treatment of fringe benefits, the employer must clearly indicate on the employee's paycheck what amounts are withheld and for what purpose, and how deductions are calculated, like you can see on this sample check and pay stub.